Hello and welcome back to Let's Talk Real Estate. My name is Kristen Jock with Compass, and on this week's episode I'm discussing a decade of low interest rates. So we've been in somewhat of an unusual environment over the course of the past 10 years with historically low interest rates. And just to give you a sense of how unusual, in the early 1980s, the interest rate on a mortgage peaked at over 18%, compared with 5.5% over the past 10 years. Low interest rates are a key driving force for real estate due to the fact that most people define what they can afford based on a monthly mortgage payment. But not only have interest rates been low for homeowners, they've been equally low for developers, builders, pension funds, local governments, and investors. The combination of all of this activity has fueled massive home price escalation. The more people can afford a product, the higher the price rises. And people, companies, and government take on more debt when it's cheaper to service. Interest rates rise when inflation rises. Currently, the government says that inflation is low. However, there's a disconnect between average America and urban city centers where inflation is notably higher, in particular the cost of housing. The Federal Reserve did in fact announce today that they would be cutting the base interest rate by 1/4 percentage point, as was suspected for the past few weeks. This is the first time that they're cutting rates since 2008 and without there being a significant economic slowdown. This is being termed as an insurance cut in order to keep driving the economic expansion. The base interest rates, which affect lending on credit cards and mortgages, will be hovering somewhere between 2 and 2.25 percentage point. As we head towards the fourth quarter, expect to see renewed buyer activity and rising home prices based on the increased spending power. As always, I hope this information was useful. Please leave your comments and suggestions below. I look forward to seeing you next week. Take care.